Okay, let's look at another problem here. Let's look at one where we're trying to calculate exactly how much is happening, how much cash in this case. We're curious about cash. We want to know how much cash was collected. Okay? Notice you read these backwards, cash and collect. So you're looking for the cash collected, not just any cash, you're looking for cash on accounts. When you see cash on accounts, you think cash on accounts receivable. Okay? Again, when you work a problem like this, be sure you know if the money's going away from you or coming towards you. Accounts receivable, money's coming towards you. Okay? So let's work it together. We've got reading it reverse. How much cash on accounts receivable did Eagle Airlines collect during 2017? Well, one of the things you look at first here is the accounts receivable. Look at all the components that potentially exist for accounts receivable. We already said cash service revenue. Cash service revenue that has nothing to do with accounts receivable or the allowance for bad debt. Or this is a distractor. In this problem, this is just a distractor. Now you do have beginning accounts receivable and you have ending accounts receivable. These are important components when you do your T account so that you can solve for how much cash was collected during the period. You have $1 million of credit service revenue. This is very relevant because this is when you debit accounts receivable and credit service revenue, in this case, airline revenue, whatever. And then you notice too, you have bad debt losses. Notice this is not bad debt expense. Bad debt expense is only booked once a year, December 31st. For purposes of our class, let's just say that. It's only booked once per year. This is talking about losses. Losses means you're writing the account receivable off. This is actually a pretty easy problem if you just take it piece by piece. And let's do just that. So we're going to focus right here on accounts receivable. Notice we took $50,000, which is beginning accounts receivable, stuck it in the accounts receivable account. Accounts receivable is an asset. Assets have a normal debit balance. Liabilities and owner's equity have normal credit balances. This is a debit balance, $50,000. You're also kindly told what it ends up being, which is $60,000. You also are kindly told that credit service revenue is $1 million. Remember, this entry would be a debit to accounts receivable because we hope to collect this sometime in the next 30 days. You would book like a service revenue account. Let's go ahead and set one up right quick. I just want to show you all the pieces here. So this would be, let's call it airfare revenue, since we hope Eagle Airways booking revenue. So here's our, I hope we collect this soon. It's an accounts receivable. It's called credit, service revenue. That's an account receivable. And then we'll book $1 million of revenue. So there's a debit and a credit. And then we're kindly told too how much we had to write off. Keep in mind when we have a credit to accounts receivable and we say we're never going to collect this is not a good thing, please don't hit cash. Cash is neither increasing nor decreasing. What's happening is we're just not going to collect this current asset. So let's just take it off the books. There's $3,000. Take it off the books. No longer is it an accounts receivable. And it's time to start debiting our allowance for bad debt or allowance for uncollectible, whatever you prefer. Kind of drilling down here for understanding, remember that once a year we make a debit, to bad debt expense and a credit to allowance for uncollectible accounts. So we probably have an amount in here. We have a tank filled with fluid, and this is working down that tank until we go down, down, down. Remember, at the end of the year, then we fill it back up with a debit to bad debt expense and a credit once again to allowance. This is just an example of a normal credit balance that's slowly lowered as we write stuff off. There's the credit, there's the debit. The only thing that's really missing from this entire analysis is the analysis of how much cash, how often did we book a certain amount here in cash, how much did we book here, a debit to cash and a credit to accounts receivable. In other words, how often or how much was the total of cash that was being collected on accounts. Cash on accounts. Let me give you a chance for a minute. I'm going to stop the video and give you a chance to calculate that. Okay, let's get back. Hopefully you were able to calculate correctly. Again, we had the beginning balance in accounts receivable of 50, ending of 60, credit service revenue of $1 million. This would be, hey, let's book some revenue. Hey, let's book some hopeful we'll collect it in the next 30 days. That's what the whole thing of credit service revenue is. And then we have some bad debt losses where we credit accounts receivable and we debit and lower the tank of allowance for uncollectible accounts. The only thing left is the plug or the adjusting entry that has to be, because for us to start with 50 and end with 60 and have credit service revenue of $1 million and then write off 3,000, we have to have 987,000 of cash collected. So we know now that this had to have been collection on AR. Same description, somewhat close to cash collected on accounts receivable, collection, whatever, accounts receivable. This is an example of backing into. Notice that we talked a great deal about a 3-4. This is a 4-5 because you were given this, given how much credit service revenue is, told how much was being written off, and then the difference is how much cash was collected. If you had never, ever had any bad debt loss, then this would be 0. If this beginning balance, let's say you had been given credit service revenue, bad debt loss, cash collected on accounts, and ending balance, keep in mind you could back into beginning balance. This is just a quickie, just shows you a little bit of how you back into things. It's important you understand the dynamics of accounts receivable, what its natural balance is, what its natural debit balance is, and then how collections of cash lower accounts receivable because we're no longer going to receive that, we've received it, and how much credit service revenue increases it as we remain hopeful of collecting that amount. This type of problem you need to be prepared for. 3, where you're given 3 and you solve for the 4th, or where you're given 4 and you solve for the 5th. I hope you found this useful.